heading into 2023, we tend to look back at 2022 and go over lessons that we've taken away or perhaps revisit predictions. And one of the things that has stood out is that no one predicted this year in terms of what we would see for a market collapse. There's an article in Bloomberg this morning that analyzes the prediction of some of the major economists or strategists at these firms, and really proving what we already know, Mark, is that predicting the S&P 500 return over a given year is just extremely challenging, if not impossible.
It's a fool's errand
to do.
It's a fool's errand.
It really is. Chuck called me out on a fool's errand yesterday. What did you know what that means? And he had me all caught off guard. But do you know what
that phrase came up?
Yes.
Yesterday?
I used the same one basically in predicting it. But
it's folly. It's foolish to undertake it. It's pointless.
Exactly.
It's a synonym for any of those.
He used a good example of you send the intern out to get coffee because he can't really screw it up, and if he does screw it up, it doesn't impact business.
Okay.
Yeah. But anyway, I did know that, but he
before
caught me
you
off
speak
guard.
in Chuck's presence, you better darn well be sure.
Yeah,
know the history and meaning of every phrase you utter.
Be on your P's and Q's.
You
I would like to ask you, Mark, because this prediction piece that's covered here, it's pretty obvious that no one really anticipated what this year was going to look like between Russia's invasion of the Ukraine, the Fed not pivoting and really raising rates much faster than we would have anticipated. I mean, substantially faster than anyone could have anticipated. The inflation that persisted. We thought supply chains unwinding was the key factor. So there was many things that went on that we just could have anticipated. But I'd like to pose the question to you. If someone was just had their head in the sand over the course of the year and doesn't follow the markets, what would be some of your major takeaways that you had from this year economically that you learned just from this market?
Look, I don't think it would surprise anybody to learn someone a Rip Van Winkle type who snoozed for a year. They wouldn't be surprised that stocks pulled back. Now it looks like it'll be about 20%, maybe a little less, depending on today and tomorrow. And when we say stocks, again, we mean the broad market, the S&P 500 index. I don't think that would surprise anybody because the past 3 years' gains have been nothing short, really, of spectacular. I'm looking here just for perspective. Last 3 years, roughly January of 2020, so right before the pandemic, to now, the cumulative return on the S&P 500 is about 35. I'm rounding up a little bit, 35%. So that's including this year. Spectacular. Before this year, it was up 28, 20. So call it 50 or so percent. Spectacular gains. Nobody would be surprised in a pullback. What might surprise them are the catalysts.
Exactly.
And you referenced some of them. The speed with which the Fed has had to act and is arguably still a little bit behind the curve, though we've had some good signs with respect to inflation over the last couple of months. The war in Ukraine. Some geopolitical types did predict it, but they're always predicting a calamity in this or that corner of the world. So we don't give that too much credence. That is largely what some people in finance would call a black swan, something that comes out of the dark tales of the distributions that we use to model returns and outcomes. Now, technically a black swan, I think, is something that can't be forecast and was unexpected. So some people would quibble with that. But the phrase gets used to mean anything that just kind of comes way out of left field and nobody even had on their radar. Ukraine probably qualifies, and the consequent and subsequent rise and then fall more recently in gas prices.
Right.
So that is a positive, if you will, black swan or positive tail, if you prefer, event.
Right.
So a number of negative and positive shocks over the past year that would have surprised somebody who started snoozing in January. Although the overall outcome, I don't think would have surprised anybody. It would not have surprised anybody. The down 20% pullback is understandable given the spectacular gains. Even the rise in the 10-year Treasury up to nearly 4.5, down back now to about 3.85-ish, starting the year at 1.6. I don't know if that would surprise a Rip Van Winkle either.
No, I think that clients out there, they've felt the inflationary pressure. They've also been able to witness the dramatic rise in rates, whether it's the money markets, the interest that they're getting at the bank, or if they're shopping for an auto loan or mortgages. Everyone seems to be well aware of the inflation impacts there. To me, my two biggest takeaways or the two biggest shifts that I've seen is the deglobalization of our economy, where you had this global geopolitical controversy with Russia and Ukraine. all of a sudden energy and where you got your resources from became much more scrutinized. The same thing applies with semiconductor chips going forward as well on the manufacturing side of things. Taiwan has a very heavy market share, Taiwan Semiconductor, and there was just this realization that you need to have a diversified stream of where you get certain products from, and Russia and Ukraine and the energy conflict, that was really one that brought that to mind for me. And the second piece would be the pivot away from growth being just enough to sustain valuations. With inflation and rising rates, what we've seen is all of a sudden that the Netflix and Disney Pluses adding, X amount of subscribers was no longer enough. That people and analysts and the market in general was really looking, and Tesla's another good example of this as well, looking more at valuations, more at profitability of a company, and less this growth story that's dominated in a very low interest rate environment that the Fed had set us up for and had led to those tremendous gains that we've seen over the past couple of years.
Right. So while I said that a Rip Van Winkle type who went to sleep a year ago might not be surprised at a 20% pullback in equities, we do live in a very different world today than we did a year ago. It's been more than a decade since the financial crisis and its aftermath, since interest rates have been meaningfully on the short end, the Fed funds rate, which the Federal Reserve targets and more or less controls, and other short-term interest rates, been more than a decade since they've been meaningfully positive. And that is dented, to say the least, growth stocks, which are discounted at those rates because they don't pay dividends. They don't have generally strong positive earnings today. So for investors, dramatically different, in a forward-looking sense, landscape.